So today we're going to be talking about the best trading edge you can possibly get. Now, this is going to take a few different things that we're going to need to break down in order to understand this, so just bear with me. So, in order to understand the best of anything, I often find the best way to start is to look at where the illegal things are. Now, stay with me because I know that sounds a little bit dodgy. If you look at something that's illegal, especially when it is something that is illegal because it provides a competitive edge, normally the illegal things give a real clue as to where the biggest edge potentials can come. Now, in the context of sport, if you take a drug, a performance enhancing drug, obviously, not great. But in trading, investing, whatever, what is the most illegal thing that you can do? Insider trading. Now, if you don't know what insider trading is, it's essentially where you have information that is, quote unquote, game changing or something that's very clear that no one else has. So if you work for, let's just say Apple, you're maybe the CEO of Apple, and you know that Apple is going to have an absolutely out of the park earnings quarter, but no one else really knows that yet outside of the company. And you decide to put a huge bet on your personal account on Apple stock, and then it goes up, you can be investigated, tried, and even sent to prison for that. Why? Because it's an unfair advantage. The markets are regulated, which means they are regulated for fairness. Now, this is not a video about me advertising, go and insider trade. This is all great. No. What I'm saying is I'm saying that if we understand that the best possible edge is essentially insider trading, is there a way that we can take the essence of what that is without breaking the law and apply that to everyday people? And the answer, luckily, is yes. So, for the record, I'm going to categorize this as what I would call an informational edge. Now, what the fuck does that mean? An informational edge is where you know something that most other people don't, that has the potential to move a particular market. That could be an individual stock. On a more macro, in other words, a broader perspective, that could be an entire like an index or something like that, like the S&P 500. It could be a foreign exchange currency pair, something like that. But whatever it is, ultimately you're looking for something where you know something that other people either don't know. Number one, they discount, meaning they see it but they don't value it. Or the third one is it is in a market that is unwatched. Okay, so let me break each one of those down. The first one is if you have key information about, let's just say, a company in this example, that is unknown. So most people don't know it. And the key word there is most. You're never going to get something where nobody knows it. But where most people don't know it, because in trading and investing, you make money when other people are wrong. Okay, you don't just make money. Like if everybody believes that, for example, Apple is going to make more money next quarter, then you're not going to have an edge by knowing that exact same fact and trying to trade it with them. It's just not going to happen. Why? Because the markets are always pricing in what they consider to be true value, which is essentially what they believe the value of the stock is going to be in the near future. That's all what you see when you're looking at a current price chart. It's the same thing. So, with that in mind, when we see information that is unknown, what we are essentially saying is most people are not aware of this bit of information that I've found. I've gone through a process to actually validate that and make sure that it is actually good information and that other people can't see it, which, by the way, if you want to know how to do that, I'll explain that towards the end of this video. But once we know that information, once we've validated it and we've made sure that other people don't know it or aren't accounting for it, then that is where we have the potential to see something rise. I'll give you an example. If we have a company that is, let's just say, not watched much. Now, what do I mean by not watched? If you take a massive stock like Amazon, Microsoft, etc., so many people, analysts, hedge funds, all these sorts of places are all watching that stock, right? Which means that it's harder to gain an advantage in those because there are more and more people watching it. Doesn't mean it's not possible. No, of course it's possible, but it's less and less likely. However, if you go to a small stock that's maybe less talked about all the time, there's going to be a slower delay of people watching it, which means you can have a competitive advantage, potentially. And so by you knowing a piece of information about, let's just say, that smaller company, not only are people going to react slower, but because less people are watching it, there's going to be probably more room for you to find something and have a bigger move when they eventually catch on. And then when people eventually start catching on, you can get out. That's the idea. And so the other kind is discounted. So discounted is where everybody knows the information, they have access to it or whatever, but they don't take it seriously enough. Now, you'd be surprised how much this actually happens, because especially if you're someone who hasn't been in the investing space for a while, and by the way, I've been investing, trading for coming up on 8 years now. You'd be surprised how much people miss. Now, I'll give you an example of two people who I'm very, very fond of in the investing space, and I'll show you how their approaches differ. But fundamentally, it's the same thing, just used slightly differently. So this is going to tie into my next point about how to actually spot these edges. So the first one is going to be someone who's very popular at the time of recording this video, called Gary Stevenson. So he has a YouTube channel called Gary's Economics. Highly recommend you go and watch that. In that, he is a ex-Citibank trader, so at an investment bank, and has constantly been correctly predicting the economy for many, many years. And he is what I would consider, and what most would consider, a macroeconomic investor, meaning he looks at the world, he looks at the flow of money, the distribution, and how things are working, and he predicts, probably on a kind of 6 to 18 month time horizon, where he thinks things like interest rates are going to be and the effect that that's going to have. For example, whether that's going to make prices more expensive on everyday people, whether that's going to push the gold price up. It can be all these sorts of things. But essentially, he takes these big, broad forces, and then he identifies something that other people miss, which in his case is distributional stuff. And I'll go into more detail about that in a moment. And then he will extrapolate that out into a trading decision and say, okay, I believe this is going to affect gold, or I believe this is going to make the stock market go up. It's a broad way of looking at it, right? But the data he's looking at there is similar data to what everyone else is looking at. He's just looking at it in a new way. So this would be an example of discounted information. And you'll find that most of the time it's going to fall into this category. When you're looking for an informational edge in the market, it's normally going to be discounted, because it's rare that you're going to come across something that literally no one on the planet knows, right? So 99% of the time it's going to be discounted or misunderstood or ignored information that everyone has access to. And so that would be an example of that on a macro perspective. Now, if you zoom in and go on a micro perspective, maybe macroeconomics doesn't interest you, and that's fine. Luckily, with this investing trading world, there's opportunities for everybody depending on what your preferences are. It's more about leaning into your personality. But on the other side, we've got someone like Chris Camillo. Now, Chris Camillo is a fascinating person. I don't know the exact numbers, but I know that he turned $20,000 into, I believe now, I don't know, $90 million at the time of recording this over, I believe 20 years. Again, that's not supposed to be an exact fact, but you go and research him if you want. Really great guy. He's got a good YouTube channel called Dumb Money, which he does with two of his friends. And he takes a similar approach, but instead of looking at the big macroeconomic picture, his goal is a shorter time horizon. And what I mean by that is he's essentially trying to beat company earnings for the most part. For example, let's just say you've identified a company, I don't know, Live Nation, which owns Ticketmaster. So they sell tickets for concerts, gigs, that sort of stuff. He will look out in the world and, he'll look for evidence of things that he can see to come up with ideas about what other people may miss. And so this ties in to what I would call the layers of information dissemination. Now, that might sound like an absolute mouthful, so just give me a sec. There are three main layers of when you want to understand something, how it ends up happening. The first layer is the observational, right? So, for example, if you are looking at the price of oil, right, the closest chance you will get to see that change in oil is out in the real world, is when you are actually buying gas, petrol, diesel, whatever for your car. You will notice it going up and down each day, or the average going up, etc. That's going to be an example of something observational. Everyday people like you and I are able to spot that. Next layer down is slower, which is distributional data. So typically this is going to be data that comes out from surveys, it comes out from certain priced markets and stuff like that, that gives you an idea of where either the economy's at, where a company's at. Essentially, it's the little pieces of data that make up either a company or an economy or a currency or whatever it is that you're inclined to trade. If you trade like an asset first, or whether you trade like an observation first, it's irrelevant. Then after you've got the distributional data, then you have the average data. So this is again something that Gary Stevenson talks about a lot, because everyone is looking from what he does with the macroeconomic stuff. Everyone's looking at the big factors. They're looking at GDP. They're looking at CPI, which is a measure of inflation. They're looking at the ISM manufacturing and services. All of these sorts of economic data releases. Everyone's looking at those, and they're just averages. They're the slowest to show up because you can't have them unless you've had all of the other micro data that goes into it. But if we just take one of those metrics, for example, let's look at personal spending. So this is how much like households spend. That is a metric where the average actually won't show what it's made up of and point out bigger problems often until it's too late. So for example, the personal spending can look like, the average can look like it's consistent, okay, throughout the year. It's like, oh, people are spending, things are looking okay. But if you understand what makes up that metric and see that, okay, even though the average has been going like this, what's been happening over that time is, in Gary's case, the rich have been spending more and the poor have been spending less. And so as an average, it blends in the middle. This is dangerous because if you ignore the fact that this has happened, you're missing the nuance of what's really going on. And this is an example of discounted information that can provide an edge. Because if you completely ignore what I just said, then you're just going to look at that average and be like, oh, yeah, it's staying the same, simple. And when things begin to shift or turn, you're just going to say, oh, maybe it's just the occasional thing. Maybe the average is just slightly shifting and it's going to go back to normal. You miss that detail, and that detail is often where some of the best edges lie. Now, in Chris Camilo's case, it's a similar case, but just slightly different, because instead of looking at averages in terms of economic data, what you're looking at there is you're looking at averages in terms of public opinion and public consensus around a company. That could be something like, people misunderstanding the iPhone. I know that's something that Chris Camilo talks about a lot. When the iPhone first got released, everyone on Wall Street and all these analysts were saying, yeah, there's no way the iPhone can become the next big thing. It's ridiculous. And then it took time before they actually realized what a massive consumer trend it was. And essentially, he was able to figure that out beforehand by not looking at all of the boring data that everyone else was looking at. Instead, he was looking at what the consumers were doing, because consumers drive company revenue. And so if you can actually understand consumer trends, you have a much better understanding of what is able to, of what a company may do, right? So in essence, it's a form of market research, right? It's market research at a consumer level, instead of looking at all of the, all of the company numbers and doing all that sort of stuff as well. Not to say that stuff is bad, but you'll often find most of it is priced in. So that's a lot of information. The kind of big understanding here is that the further you go up in layers, so the further you get to layer 1, and there are layers above layer 1, like maybe we'll call it layer 0, but it's kind of a little bit more complicated. I'll go over that in another video. But observational is going to be the shit you see day to day in the real world. That could be seeing how much of a particular item is stocked on, in a supermarket, grocery store, whatever, and then seeing that over time, how it changes, and then looking to see if there's any opportunity there, which seems small, and most of the time it will be, and it will be irrelevant, but occasionally it will be something big. Or that can be on a macro perspective where you're like, okay, what's the weakness of what everybody else is doing here? And then are there any things that they're discounting that actually do move the needle, that do drive a particular change? And then you are understanding how to do that. So in order to actually make that work, there are a couple of things you need. The first thing that you definitely need is you need to understand what time horizon you're looking at. Predicting the next week is very different to the factors that are going to influence predicting the next 3 months. And even more, it's going to be different to the factors that are going to predict the next 12 months, the next 18 months, the next 5 years. These are all different disciplines. If you're not clear on which one you are trying to define, it can all get messy, because you will find conflicting information at every single stage, and if you merge them, there's too much and it's going to confuse you. It confuses me, it confuses everybody. And so time horizon is the first thing. The second thing is really understanding what moves the needle. What am I trying to predict? Chris Camillo, for the most part, is trying to predict a beat in earnings, meaning if everyone expects that a company's earnings is going to be 100 million in profit, but you predict that it's going to come out at about, I don't know, 120 million in profit, and no one else expects that. That is an example of you finding information that has a clear outcome. You're expecting and anticipating that it's going to cause an increase in company profits. That's a specific outcome. And then if you tie in a specific time to that, you're like, okay, earnings happen typically once a quarter, so every 3 months. So, okay, my time horizon is basically, for the most part, 0 to 3 months. That's a very, very key, good setup. Now, Gary, on the other hand, he is doing kind of 6 to 18 months to the best of my knowledge. That would be my guess based on the way that he looks at the world. And that makes sense because what he's doing is he's predicting bigger macro moves, broader moves in the market. Things tend to move slower in that industry, in that way of doing things. And so therefore, it's going to be a little bit different. And so if you want to understand how to do those things, that's exactly what I talk about here or here, whatever the hell it is, in the next video. Take care, and I'll speak to you soon.